number one thing, how to deal with the bear market, don't panic. Pretty simple, pretty obvious. I don't think I'm reinventing the wheel here. Don't panic. In fact, don't panic is good advice for pretty much every area of life. I think that's a Hitchhiker's Guide to the Galaxy reference, actually. And on Elon Musk's Model S that he launched into space, I'm pretty sure it said "Don't panic" on there inside the car. So, yeah, don't panic. You don't have to make any decisions. It is not your responsibility. You have no responsibility to try and sell before a downturn. It's not something that you need to be able to do to be a good investor. I'm 33 years old. I don't sell anything. I buy things that I think are worth holding for a long time, and I just accumulate them. Only buy, never sell. And there's a good reason for this. I mean, this isn't just me. People are like, well, yeah, well, you're a skydiver too. You're just used to taking risk. Elon Musk's pops up. Let me show you. Look, my man Michael Batnick. Shouts to Michael Batnick and Ben Carlson, everybody at the compound. They put out really good content. And recently he put out this chart. Growth of $1, going all the way back to 1926 to now. And all of these things are things that might cause people to panic. I mean, Pearl Harbor, like someone dropped a bomb on U.S. soil. That's probably cause for concern, right? But if you held on, we ended up winning World War II and creating a massive economic boom that, I mean, when you zoom out, and that's actually point number 2, is zoom out. Look at this, the growth of $1 over time. It's like basically straight up. Although if you look at all these little dips along the way, you can rest assured that there are negative headlines. There are people recommending you sell. There are people calling for the crash, calling for the end of everything, blah, blah, blah. But check us out. We're still right around all-time highs. So the best thing that you could have done all throughout history since 1926, the best thing you could have done is buy U.S. businesses and hold on to them for dear life. And I don't think it's different this time. Howard Marks is a very famous investor, very, very good writer and speaker. And he said the 4 most dangerous words in investing is "it's different this time." The more things change, the more they stay the same, and would fully expect this to continue. Maybe not in the short term, but given enough time, and that's the third point. No, that's not the third point, but it should be. The third point now is remember your time horizon. You shouldn't be investing money if you're going to need it anytime soon. That's kind of, if you're talking about like needing to preserve capital and needing the money in the next year, 2 years, 3 years, anything less than 5 years, really. 5 years is like a bare minimum. If you're going to need that money in the next 5 years, probably not a good idea to invest it. And if you are going to invest it, probably not a good idea to have it all in equities. Probably not a good idea to put it in crypto. Of course, after 12 years of everything going up and everybody on the internet shouting about how you're a dumbass for not investing, look how rich I'm getting, blah, 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 makes it seem like putting your savings, even if it's a short term, putting it in the market because shoot, look how much it's costing me to not be invested, right? It's all short-term focus. Great investors understand that probably the number one mistake investors make is focusing too much on what's happening right now. This is a long-term game, long-term game. I wasn't going to sell my stocks today anyway. I wasn't about, there's nothing in my mind saying, hey, I'm thinking about cashing out soon because guess what? I've only invested money that I don't plan on using anytime soon. So that's something for 60-year-old AJ to worry about, not 33-year-old AJ. And I have no doubt, I would bet, in fact, I effectively am betting everything that I have on the fact that when I'm 60 years old, markets are going to be a hell of a lot higher than they are right now. And that's really what matters. What happens in between is just psychology. I mean, if you could just invest, close your brokerage, not close, but delete the app, lose the password to your brokerage account, you'll probably be much better off. In fact, Fidelity did a study that showed the highest performing accounts on the Fidelity platform were accounts of deceased people. meaning that they were too dead to panic over a 3% decline in a day. Doing nothing almost always is better than doing something. There's a bunch of cliches about it where everyone's saying, don't just stand there, do something. The intelligent investor says, don't just do something, stand there. I mean, it's buy and hold, not buy and hold unless things dip, not buy and hold unless there's inflation, not buy and hold unless Trump gets elected again or something, like whatever. None of that matters. It's buy and hold, period. That's it. End of story. If you buy right, you can hold tight. So that brings us to our third point, which is remember what you own. It's not a squiggly line on a screen. It's not just a lottery ticket. I mean, what you own is a piece of a business. Now, my crypto folks, the story's a little different because in markets, in the stock market, you have companies that they have to report their earnings every 90 days. Most of them, penny stocks, different story, which is why we don't bother messing with penny stocks. But again, to each his own. But in crypto, I'm not even sure how the tokens we buy do they entitle you to your pro rata share of profits the way a stock does? Because if I own 1% of Apple computers, then I'm entitled to 1% of Apple's assets and Apple's income. I'm a part owner. When I buy Ethereum, I don't know if that entitles me to my pro rata share of the proceeds of Ethereum's profits. Like, I guess really it's just gas fees. I'm not sure what I'm entitled to when I own Ethereum. I mainly own it because it costs money to operate, to play around on the Ethereum blockchain. I'm doing more Avalanche recently, actually. It's kind of nice having it. So I do transactions that like I really don't even need to do. It's like a self-flex. Like, check this out. I just did that and it cost 8 cents. But I digress. Besides the point. You got to remember what you own. So I'm looking at the S&P 500 down 3%. But when I look at this, I think, well, you know what? That means that I own Apple. That means I own Microsoft. That means I own Tesla. That means I own Amazon, Facebook, Google, NVIDIA. I mean, I own, let's see, Phil, show us components here. Nope, but we can go to VOO, which is, VOO is Vanguard's S&P 500 ETF. Effectively, this is the exact same thing as this, but you'll see the expenses here is 0.03%, and you find other funds that also hold the S&P but charge more to do it, which never really made sense to me. I don't understand why you would go anywhere besides this unless you're a Fidelity customer and you have access to FXAIX. That's Fidelity's S&P 500 fund, and it is actually look, they don't even show. Oh, yeah, expense ratio 0.01%. So it's funny to say, but VOO is 3 times more expensive than the Fidelity one. But I'm pretty sure you have to be a Fidelity customer to buy that one. I think. It's also a mutual fund, not an ETF. So there's that. But again, let's look at the holdings of VOO. Apple, Microsoft, Amazon, Facebook, Google, Berkshire Hathaway, Tesla, NVIDIA, JP Morgan. Even though it's down 3% today, I mean, look, back in March 2020, these things dropped like 13% in a day, a couple times. And I was elated. I was having a great time because I wasn't planning on selling anyway. I was planning on buying. So when things get cheaper, you can buy more of it for the same price. I mean, they say the stock market is the only market where when things go on sale, people run out of the store. It's like it doesn't make any sense. But I think that all stems from the fact that most people don't really know what they own. They see it as just a line on a screen, and when the line goes down, they don't have anything in their mind to keep them anchored, to remind them of why we're doing this. Why did we buy this in the first place? Well, it's because we like American business for the long haul. We think that more iPhones will be sold in the future, or more Apple products, I should say, will be sold in the future. Microsoft. Think about. Let me see if I can find this meme for you real quick. should have known there's a lot of Microsoft Excel memes, but there's one where it's Atlas, like the guy holding up the globe, and it's like the guy holding up the globe is Excel, and then the globe is the entire global financial system, which, honestly, without Excel, the global financial system does not function as usual. It's interesting, and I know Microsoft is way beyond just Excel, but it goes to show you these companies have staying power, what we call a sustainable competitive advantage. And I'm not worried about what the price does over the next day, month, week, year, or really for me even decade, because I'm not selling. I bought Apple in 2015. Haven't sold a share, and probably will never sell a share of Apple if you think about it. Because number one, you can borrow against your holdings. You don't have to sell them and incur taxes. You just borrow against them for cheap right now. It's like, I could borrow against my stocks for like 2%. Number two, I don't think that I'm going to end up like spending my last dollar the day I die and dying with nothing. I'm going to amass wealth, and it'll go into my company, TOS Financial Group. It'll go to my loved ones. It'll go to some charities. But I don't need to sell Apple for my entire life. It's something that I bought and I will hold forever. And there's a lot of companies like that. You just buy this and never sell it. You just buy it and never sell it, and you continue to buy it over time, regular intervals over time. What I like to tell people is Roth IRAs. You can put $500 a month, $6,000 a year. Traditional IRA, Roth IRA. I say Roth because everybody seems to like Roth better. Like they just feel like it's more clever. It's not just an IRA; it's a Roth IRA. May or may not be the right thing for you, but that's another story. Now let's take a look. Let's take a further look. I feel like you're still not convinced on this. Don't panic. Just buy it and hold it. So I want to show you something. These companies report their earnings every year. Okay. So let's take a look. Whew. That's an amazing chart. And for good reason. Like this is not, well, is it overvalued or not? Okay, hold on. First of all, let's stop. Let's break this down real quick, okay? Whenever I go to look at a stock, the first thing that I do is look at its market cap. What's the price tag? Because this number doesn't really mean anything. If you don't know how many shares exist for Apple, then this number is totally meaningless. A lot of people think like if Apple trades for 150 and Amazon trades for 2,700, then Amazon must be worth, what is that like? Let's see, 2,700 divided by 150. 18. Amazon is not worth 18 times more than Apple. In fact, Apple's the most valuable company in the world. You have to look at this number, market cap. So if you bought every share of Amazon, it would cost you 1.39 trillion. If you want to buy every share of Apple, it'll cost you 2.56 trillion. So that's really the number that matters. Is you got to approach this like you're going to buy the entire business. It's essentially what you're doing, just you're fractionalizing, but you're buying a business. So say, okay, the price tag is business 2.56 trillion. Actually, even a better way would be to go straight to the financials and come up with your own valuation. You determine what you think the price is. What is this actually worth? Just like if I was going to buy the sandwich shop across the street from me, there's no ticker symbol there. There's no one. I'm not informed of what other people think about the business. So I have to do my own homework. No one else is going to tell me what people generally think the price is. I have to come up with it completely on my own. There's no ticker, so I have to actually look at the business itself, which is what you should be doing in the stock market anyway. Sorry to the technical analysts out there. There's a time and a place for it, but that is secondary to the main goal of actually investing, actually buying, holding quality businesses. So you would go here and you look, okay, 2018. This is their revenue. This is how many dollars they brought in the door. And it's pretty incredible to see. Very few companies in the world make this much money. So to see them grow this from $265 billion, remember all numbers are in thousands. So this is $265 billion. This is $365 billion. And then after all the costs, they are very, I've seen this a bunch of times, but it still just amazes me. So then we'll do something like, where's my calculator? So let's see, what's their net profit margin? 92. Where should we go? 94 billion divided by 365 billion. 25% margins. Largest company in the world, still growing, still producing 25% margins. So if you look at just the price tag, you're like, holy shit, $2.5 trillion. But then you start looking at why. And this is just what they earn. We haven't even talked about what they own. Right? So in addition to the 100 billion in profits that they're going to make next year, likely, they also have 350 billion in assets. Got a lot of liabilities, yes. Another secret about, people never want to loan you money when you need money. But when you don't need money, everyone wants to loan you money. Any lender is trying to loan money to people who don't need it. And they're willing to accept very low interest rates just to get that loan on their books. It's just the way Wall Street operates, right? So Apple actually borrowed, they did a bond offering last year and raised, even though they have all this, let's see how much of these assets are cash. $134 billion in cash in the bank. I mean, it could be in short-term treasuries or whatever. A lot of it's receivables because everyone's on a purchase plan for their iPhone. So this is money that people have received the iPhone and they've obligated themselves to pay. This was not in the bank yet. Still, 62 billion in cash, 51 billion in receivables, only 6 billion in inventory. That's really, you don't want to see a ton of inventory. You don't want to see a ton of intangible assets goodwill is a big one on a lot of balance sheets. I actually don't see goodwill on here. We got to look at the non-current assets, property, plant, equipment, investments in advance. But see, I don't even see goodwill, which again is amazing because you look at other companies. What's a good example? Tilray, much smaller company. I mean, this is a whole nother universe we're entering here. Tilray is a they were 10 billion when they merged with Afria, but now they're a $2.5 billion company. And let's look at their balance sheet. You say, oh wow, 6 billion in assets. That's pretty good. Now, by the way, I actually like Tilray. I mean, I know it's been hammered pretty hard. I think they'll probably be pretty successful. Just a guess, but again, smaller companies, more volatile. They're pioneering a new industry. It's very risky, very uncertain. So if you want to buy Tilray, you better get ready for some volatility. I mean, it's crazy to see. They reached $300 a share in 2018. But let's just look at the last year. I mean, it's hard to tell here, zoomed out, but 52-week range. There you go. It's gone from as high as 67 to as low as $5.20, which is where it just hit today. So, just be ready. If you want to get into these kind of stocks, just be ready. But anyways, back to the point. Let's look and see how much goodwill. They have $6 billion in assets. How much of that is intangible? All right. So the current assets, $500 million in cash. It's encouraging. Receivables. See, they got a good bit of inventory compared to, as a percentage of their current assets. It's a good bit of inventory. Now let's look at non-current. Goodwill and other intangibles. So look, you see this? Assets of $6 billion. 4.4 of that is goodwill and intangibles. This is the value of their brand. And goodwill really is a measure of if a company, they acquired another public company. That company's trading for $2 billion on the open market. Tilray buys it for $3 billion. So you put $2 billion as in tangible assets, and then the other $1 billion goes into goodwill. Now, it's a super basic. That's not technically correct, but it's close enough. Goodwill. Some say goodwill is a measure of how much a business overpaid for another business. The upshot is that it's depreciable, so you could get a little depreciation on that, but this company doesn't really need a lot of depreciation because they're not profitable yet. So big switch from something like Apple, who doesn't even show their intangible, or they don't even